Now it's time for Hot Picks. Our next guest is focused on ETFs, and he says his 3 picks are good bets to hedge against market volatility. Let's find out what they are. Joining us now is Aniket Ullal, head of ETF Data and Analytics at CFRA. Hello, Aniket. Thanks for being with us.
Thank you.
So let's start with this Innovator U.S. Equity Power Buffer. You got to love that name. This is an ETF. It is a hedged vehicle. Now, before we get into how it works, would you say that something like this is really only for sophisticated investors, or not necessarily? It could be for anybody.
It's available to all investors. These products are certainly a little complex because they require understanding the caps and the buffer limits on each product. So I would say they require more due diligence than the average kind of index product, but certainly they're available to retail investors. They're quite popular with advisors in North America.
Okay, so how does this work? I understand that there's some sort of a guaranteed return. Could you explain it?
It's not really a guaranteed return. I'd characterize it more as a bounded return. So essentially what happens is that an investor getting into the product at a particular point in time, these products are actually launched as a series. So the one that I recommended, P5, is actually the February series. So what happens is you essentially are giving up some potential upside in exchange for some downside protection. So an investor who gets into P5 today would essentially be, their return upside would be capped at about 11%, but then you get downside protection for about 14% of your losses. This is essentially the issuer is using options contract to provide kind of a bounded outcome. This has not been an easy week to pick ETFs, and so the only thing we know is there's probably going to be more market volatility ahead, and so we think this is the right type of product for this environment, where the market may move sideways, or maybe we're looking at single-digit returns, and so giving up some upside for some downside protection seems like a reasonable strategy right now.
Aniket, we looked at the chart there and we saw in August that it's a good chart, number one, but in August it fell with the markets. That was August 5th when there was that issue with the Japanese yen. Did it outperform in that scenario?
Generally, when the market, yes, it does outperform when the markets are falling. Obviously, calendar year 2024 was a very good year for the U.S. market. So it was about 14% calendar year last year relative to mid-20s for the 500. But in an environment like this, where you're expecting a little bit more volatility and maybe the market doesn't have the double-digit return, it's probably more appropriate for 2025.
All right, another hot pick here is GDX, which holds a basket of gold stocks. We know that gold itself has done very well, sitting near all-time highs. Central bank buying, according to the World Gold Council yesterday, they've been net buyers for the past 15 years, and central bank buying has doubled since the invasion of Ukraine. But you're recommending stocks. So why stocks over gold itself?
Well, it just provides, in this environment, a little bit more leverage in terms of returns. If you look at gold last year relative to stocks, actually the underlying commodity did much better. It was up 24% relative to about 14% or 10% in the underlying stocks in GDX. This year it's actually reversed. Gold's been up about 8%, whereas GDX is up about 18%. We have a team of fundamental analysts who look at various sectors and stocks in a lot of detail. We have 4 or 5 stars buy or strong buy ratings on a lot of the underlying stocks in GDX. And so for these market conditions, prefer to pick equity exposure rather than gold, just to get a little bit more juice and returns, because we're quite bullish on the underlying stocks. You're right that the underlying thesis for gold is certainly central bank demand has been strong, particularly those governments that want to hedge away from just having U.S. dollar reserves. There's always demand from emerging market consumers. And just given the current environment, we think there's going to be more demand for gold as a hedge against market volatility.
It's interesting, as you know, there had been that big disconnect between gold and gold stocks, and gold stock investors would complain about that, especially for the smaller players, the juniors. But that seems to be reversing. There have been false dawns for gold stocks before where they seem to be running and then they roll over. Do you think that this is a time now where gold stocks can really run and have those outsized gains that they get sometimes over the course of a few years?
Absolutely. If you look at 2025, what we've seen early this year relative to last year, the gold stocks are running ahead of the underlying commodity. And like I said, our analysts are actually quite bullish on a lot of the underlying stocks. We have, 4 or 5 star ratings on Barrick and Newmont and a couple of the other large cap companies.
All right, and your other hot pick here is the iShares MSCI Emerging Markets ex-China. Why emerging markets when the U.S. dollar is fairly strong and could get stronger?
Again, this was really driven by a couple of things. One is just the fact that we've got so much uncertainty around the trade agenda in the U.S. We think countries in other regions may try and group together, do more trade with each other. So kind of a longer term play, both on that, as well as the fact that obviously we've got tensions between China and the US right now. We may see in the longer term more or continued kind of restructuring around supply chains. That should benefit countries like India, Vietnam, Korea, and so on that are in EMXC. EMXC is kind of a trend that we've seen over the last few years, as companies kind of diversify away from China and China risk. Because if you look at traditional EM exposure, China still makes up more than 20-25% of that fund.
Right.
And so this allows ETFs to get, investors to get exposure to markets outside the US, diversify away some of the trade risk and trade policy risk in the US right now.
All right. Thank you for the ideas today, Aniket. That's Aniket Ullal, head of ETF Data and Analytics at CFRA.